I'd rather be the US than China. China's in even worse shape for different reasons. It's not so much interest rate policy, although they're subject to global interest rate policy and exchange rates influenced by the Fed. But you can see it in real estate. It's a full-scale collapse. They're propping it up, but the buyers aren't interested. In other words, the Chinese government is telling the banks to lend money to real estate developers who can't finish housing projects. Well, that sounds good. It's like, okay, here's some money, finish the housing. But the buyers are not flocking in. The buyers have been burned. They're shying away from that asset class. They want to increase cash holdings. They're looking at other asset classes. They don't have a lot of choices because China has very strict capital controls. They're trying to get their money out by means legal and illegal. They're buying gold when they can. But as I say, they may not have a lot of choices, but even money in the bank looks pretty good compared to what's going on in real estate. The problem is too big. The bubble is too large. It's gone on for too long. We don't hear about it the same way we did about the Japanese real estate bubble in 1989-1990. That was an epic crash. Japan has still not recovered. I remember in the 90s, early 2000s, they talked about the lost decade. Well, try 3 lost decades. That's going into a 4th. That's Japan. 8 or 9 recessions since 1989. But it's really just one long depression. That's the way to understand the Japanese economy. China's going into something like that. We don't hear much about it because they're not transparent. They lie about their numbers. You need to look at private sources and use other analytic tools to understand what's going on there. But they've got, drops in consumption, industrial output, real estate's collapsing. Their price indices are collapsing. All this in fear of inflation. It's been around. It's real. But it's now turning around very quickly. And you can see that in China. China's going through something that the world has never seen. They're going to lose 600 million people in the next 50 to 70 years. This is a demographic implosion. This is worse than the Black Death. Of course, the Black Death killed somewhere between a third and half the population of Europe in the 14th century. It was a good time for labor. By the way, labor was so scarce that returns to labor went up versus returns to capital because there weren't enough workers. But that's the only thing that can come close. Even the Spanish flu of 1919 killed about between 100 million and maybe over 200 million people. The 30 Years' War in the early 17th century was certainly highly destructive. But what's going on in China now is worse than any of those things. Simple demographic math. The key number is 2.1. 2 people have to produce 2.1 children. You, man, woman, or you can say per woman if you want, have to produce 2.1 children to keep the population constant. Why not 2? Why not 2 producing 2? The answer is infant mortality, and those who don't make it to adulthood and can continue the repopulation of the planet, if you will. But they're not even close to that. They're well below 2. And by the way, so is the rest of the world. So is Australia and the US and Western Europe and a lot of other places. This is a global phenomenon, but it's particularly acute in China. Maybe the case that China's birth rate is actually 1, has to be 2.1 to maintain. It could be 1 or lower. This is a demographic implosion, unlike anyone has ever seen. It also has a dynamic. You can't reverse it very quickly. It feeds on itself, as I was talking about inflation earlier. So this is going to continue for 50 to 75 years. They're going to lose 600 million people. There are a lot of definitions of GDP, 4 5-part definitions. There are more complex calculations, but there's one really simple definition. It only has 2 factors: population and productivity. How many people are working and how productive are they? That's nominal GDP. That's one definition of gross GDP or nominal GDP. Well, if your population is dropping from 1.4 billion to 800 million, you're losing 600 million people. And then what about productivity? Well, the other thing that's going on is China's population is aging very quickly. So you get a population set, people in their 70s, 80s, and 90s, with very large amounts of cognitive decline, dementia. Obviously, there's no productivity there, but it's worse than that. Because then you look at the shrinking population between the ages of 25 and 54. It's called their prime working age. More and more of those people are going to have to be involved in elder care. They're going to have to be basically caretakers or caregivers for the older population I described. A very worthy job, but not one that lends itself to productivity gains. Bathing hasn't changed in about 5,000 years. Robots don't do it best. The only real innovation in bathing between 1870 and 1940 was the rise of indoor plumbing and hot water. That's good. I enjoy both, but that's it. I can't think of any other bathing innovations in the last several millennia. So if you have a shrinking working age population, a rising older population, a high degree of cognitive decline, and a big slice of the working age population having to provide elder care or be caregivers for the older population, tell me where your industrial output's coming from. Tell me where your productivity is coming from. And 50% of the water in China is poisoned because of their industrial practices. You know, if you're a gold miner in Australia, I invest in gold mines around the world. I know that places like Canada, the US, and Australia, if you use cyanide to leach the gold, and that's a very common technique, you have to account for every microgram. Whatever you put in, you have to take out, weigh it, dispose of it properly. In China, they just dump it into the rivers, and so the rivers are poisoned. So China is an economic, demographic, industrial, moral, religious wasteland and will suffer. It's already in a recession. Just to cut to the chase again, they lie about their statistics. So here you have the two largest economies in the world, the US and China. The US is slowly going into what I expect will be a severe recession. China is in a century-long decline, unlike one that the world has ever seen. That could eventually lead to social unrest, regime change. But let's not count on that in the short run. Just expect China to shrink and become more erratic, decoupled from the Western world, and certainly not be a source of growth. Taiwan's semiconductor manufacturing company, the largest and most sophisticated semiconductor manufacturer in the world. And semiconductors are in everything. It's not just computers. There are 1,400 semiconductors in an automobile. There's a semiconductor or more in your dishwasher, your refrigerator, your washing machine. They're everywhere. Internet of Things. We all understand that. So TSMC is based in Taiwan. The United States has a military doctrine called the broken nest theory. And what it says is that if China, well, it comes from a Chinese proverb, ironically, and it says if the nest is broken, how can the eggs survive? And what it means is that if China invades Taiwan, I'm not forecasting an invasion. Could happen though. We or the Taiwanese will very quickly destroy all the semiconductor manufacturers in Taiwan. We'll just blow them up, and China won't get anything. They'll have the broken nest. Taiwan Semiconductor knows this. They talk to the US intelligence and military community all the time. They've just announced 2 separate $10 billion plus investments in Arizona for semiconductor fabrication plants. They're so-called fabs. Intel did the same thing, $10 billion plus, 3 to 5 year horizon. Fab they're building in Oregon or Washington, but in the northwestern United States. Why are Intel and TSMC putting over $30 billion into two fabs in the United States? Can't you get cheaper labor in China? Yeah, these things are not going into Taiwan. They're not going into China. It's an example of the decoupling of the coalition of nations I'm talking about. They're building them in the United States. A little more expensive, yes, but more robust. Shorten the supply chain, shorten the transportation lanes, put them into a rule of law society, do everything you can, everything you need to do to make it safe. And that's what's going on. And Australia will be a big part of that. It will have very important, already does, but it'll have more important relations and transportation channels to the United States. Not so much with China for the reasons I mentioned. The thing I would point out is that there are bull markets and bear markets. It's in basically any tradable instrument or commodity. And I consider gold to be a form of money. But what we're really talking about when we say, gold is up, we're talking about the dollar price of gold. And I view it as a cross-exchange rate. People talk about the dollar, the euro-dollar exchange rate. Well, there's a dollar-gold exchange rate. And that's the dollar price of gold. So they're just alternative forms of money, where people get to express a liquidity preference or a credit preference, if you will, if you're losing confidence in the dollar. But the first great bull market was from 1971 to 1980, lasted 9 years, and gold went up 2,200%. The second great bull market was from 1999 to 2011. Gold went up just a little under 700%. But in between, you had a bear market from 1980 to 1999. It was a long one. Almost 20 years. Gold dropped from $800 to $250 at the bottom in 1999. And we had a second bear market starting in 2011. Now, I had a very interesting conversation with Jim Rickards. Jim is one of the great commodity traders, money managers of all time. And we were down in the Dominican Republic at Casa. This was around 2014, but, the bear market started in 2011. But it really fell off a cliff in 2013. So I said, Jim, what do you think of gold? What are you doing? He goes, well, I own it, of course. And he said, I'm not selling, but I'm not buying right here. And he said something that just hit me right between the eyes, and it stayed with me. And of course, he's right. He said, gold's going to the moon, but nothing goes to the moon without a 50% correction along the way. And if you look at the high in 2011, $1,900, approximately, and where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time. But if you look at that drop down, you use $250 as your base, which you need a base. So you had basically the run from $250 to $1,900, which was $1,650. Go down 50% from there. It's $825. $1,900 minus $825 is $1,075, and the bottom was $1,050. So Jim totally stuck the landing at $1,050. Like, okay, there's your 50% retracement. Now that's the bottom. Now it's going up, and the sky's the limit. Well, we're not overheated at all. I've got gold at, I would put a $15,000 an ounce, but as I point out, if you're going to $15,000 an ounce, you have to get to $3,000, $5,000, $7,000 first. So there's plenty of room to run, plenty of room for profits. But When I say things like that, I want to be clear. There's a lot of analysis behind it. I don't just pull a big number out of the air for publicity, because I could care less. But if you just took the average, and there are a couple of ways to think about it, just take the average of the two prior bull markets I mentioned. So 1971 to 1980, 9 years, 2,200%. 1999 to 2011, a 12-year bull market, about 700%. Just take the average. You don't have to go to the higher of the two or extrapolate. Just take the average of those two bull markets. You would say, okay, it's going to go up 1,450%. So, using that as your base, just take the average of the two, and at, 1,450% puts you at $15,000 an ounce off a $1,050 base. So that's just history. But there are other ways to think about it. Now, I don't know if there'll be a gold standard or not, but I do know that gold will move. The price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And I talked to Paul Volcker about this, and he agreed. If you just took the money supply, so just take M1, which is, a pretty widely accepted definition of money supply. Take it for the US, ECB, UK, Bank of Japan, People's Bank of China. There are other entities you could include, but that's over 75% of global GDP right there. Divide that number by the official gold, which is about 34,000 metric tons, a little bit less. You'd come to $15,000 an ounce. So, if you're going to either have a gold standard or even use gold as a reference point for money, if you need to restore confidence in the dollar, the implied non-deflationary price is $15,000 now. So, what I find interesting is that if you use just the history of the last two bull markets and average them, or if you use, a rigorous calculation, what's the implied non-deflationary price? Interestingly, they come out in the same place. I don't think they have to. They're two different methods, but they both point to $15,000 an ounce sometime over the next 3 or 4 years. It is a moving target. The numbers I gave you were based on current levels. If you keep printing money, you need a higher price. If you want to reference gold and not cause deflation, which they don't, you're going to need a progressively higher price of gold. One thing people forget, they look at the dollar price in absolute dollars. So it went up $100 an ounce, or, I expect before long it'll go up $1,000 an ounce a week. But each dollar increase is a smaller percentage increase. So, people look at the dollar. It's real money. It's nice to make the money, but, if you go from $14,000 an ounce, percentage increase gets to be pretty small at those levels. And when I say $15,000 an ounce, I don't think I'm stretching. I mean, could it be $25,000? $40,000? I mean, just take my monetary equivalent. If you use M2, and by the way, when I used M1 and did that math, that's with 40% backing, because historically 40% has been a high level of backing. If you take M2 at 100% backing, you get to $50,000 an ounce in a heartbeat. My numbers, I think, are conservative. They could be much higher. But the thing I would point out is that the Fed dug a hole, and they can't get out of it. And I said in 2014, 2015, etc., as they did the taper and then they did the liftoff and then they raised rates and all that, I said the Fed is trying to get out of this. They're trying to normalize the balance sheet, trying to normalize interest rates, but I also said they won't be able to do it. And that's exactly what happened in the fourth quarter of 2018. Between October 1st and December 24th, 2018, the stock market dropped 19%. It was 1 point away from a bear market at that stage. And then you had the Christmas Eve massacre. And that's when Jay Powell threw in the towel. He got religion. He said, okay, first he said, we're not going to raise rates anymore. Then he said, we're on pause. Then he said, we're actually going to cut rates. And then 9 months later, he said, we're going to end quantitative tightening, which is reducing the money supply. And then September 2019, they started QE4, which was before any recession, before the depression, before the pandemic. They were already in QE4 and cutting rates again. So they can't get out of it. Now it's worse. So they proved that the failures manifest. They proved that they can't get out of it. And what can they do? By the way, on monetary theory, you say, what's the secret behind money? I think it's garbage, by the way, but you say, what's the secret behind it? Well, the secret behind it is if you can issue debt and collect taxes in the money that you print, you can force people to accept the money because they need the money to pay their taxes. And if they don't pay the taxes, they end up in jail. Now, you can get extensions or, do whatever, but at the end of the day, if you manifestly refuse to pay your taxes, they will come and put you in jail. And the point is, it relies on state power. It's really a neo-fascist concept. It relies on coercion. The point of a gun, jails, and state power to enforce the confidence in money. And they say that I've read Stephanie Kelton. She's the bright light. This goes back a long way, but I've read her book, I should say, and her articles, but they're very explicit about that. Now, I think that's completely wrong because there are so many workarounds and so many ways to get out from under that kind of state power. But they do rely on state power at the end of the day. That's why it has this neo-fascist element.